A frothy rally cooled rapidly as Fed Chair Jerome Powell's cautious stance on interest rate policy rattled investor expectations, pouring cold water on hopes for a September rate cut and injecting uncertainty into markets, businesses, and household finances. This deep dive analysis unpacks Powell's latest remarks, explains their impact on interest rates, inflation, bond yields, and equity markets, highlights internal Fed divisions and political pressures, and outlines what investors, workers, policymakers, and businesses should watch and do next. What Powell said and what uncertainty means. Fed Chair Jerome Powell delivered a measured post-meeting press conference, reiterating that no decision has yet been made regarding a rate cut in September. He stated plainly, "We have made no decisions about September. We don't do that in advance." This marked a break from earlier market assumptions of a likely 25 basis point cut. Within hours, the probability of a September cut dropped from roughly 63% to just under 50%. Markets responded quickly with rising Treasury yields. 10-year rates climbed to approximately 4.37%, and two-year rates approached 3.93%. This cautious tone led investors to reassess their expectations. Powell's emphasis on being data-dependent, along with the statement that further evidence is needed before easing, signaled to financial markets that the Federal Reserve is not in a rush to pivot, especially if inflation remains sticky. Economic scene, moderating growth and inflation risks. The second quarter GDP expanded at an annualized rate of around 3.0%. There are clear signs of deceleration. The Fed acknowledged that growth has moderated in the first half of the year. The labor market is said to be in balance, a shift from earlier descriptions of tightness. Unemployment sits at 4.1%, but hiring has slowed, and that metric will be watched carefully over the coming months. Inflation remains elevated. The core personal consumption expenditures (PCE) index, a key inflation gauge, remains around 2.7%, well above the Federal Reserve's 2% target. Powell also pointed to the inflationary effects of new tariffs, estimating they have already added roughly 0.3 to 0.4 percentage points to prices. He emphasized that it's too early to determine whether this impact will be temporary or more entrenched. As inflation proves stubborn and growth slows, the Fed finds itself navigating a fine line between holding rates high enough to control prices and easing enough to avoid a hard landing for the economy. FOMC dissent and political crosswinds. For the first time in over 3 decades, two sitting Federal Reserve governors dissented from the official policy stance. Christopher Waller and Michelle Bowman voted in favor of a 25 basis point cut at the latest meeting. This signals a visible fracture in the Federal Open Market Committee's consensus. While Powell called the disagreement constructive, the dual dissent highlights just how contentious the current environment is. Inside the Fed, some believe inflation has cooled enough to justify easing, while others worrying about premature cuts triggering another price surge. Outside the Fed, political pressure is mounting. President Donald Trump has criticized Powell for being too slow to cut and has even questioned his leadership. A controversial $2.5 billion renovation project for the Federal Reserve building has also attracted criticism from conservatives, leading to speculation about Powell's tenure and whether political forces may attempt to reshape the Fed's direction ahead of the 2026 election cycle. Impact markets, workers, and policymakers. For investors and markets. Equities, tech and growth stocks, which had soared in recent months on rate cut expectations, pulled back. The Dow Jones dipped about 0.4%, the S&P 500 slipped slightly, while the Nasdaq remained buoyant thanks to strong tech earnings. Bonds, Treasury yields spiked, particularly on short and medium-term maturities. This flattening of the yield curve signals investor anxiety over economic stagnation without adequate monetary relief. Currencies. The dollar strengthened amid a repricing of interest rate risk and global capital inflows seeking higher yields for workers and the labor market. With unemployment steady but job creation slowing, wage growth may soften in the coming months. Households could face continued strain from higher borrowing costs, including mortgages and credit cards. Any uptick in joblessness would quickly shift the Fed's calculus, making employment data the most important indicator to watch heading into September. For policymakers and governments, interaction between tariff policy and monetary strategy is becoming more complex. Rising prices from new tariffs could prevent timely rate cuts. Meanwhile, Powell's insistence on independence is being tested. If political attacks continue, investor confidence in the Fed's ability to make unbiased decisions could be undermined. Especially in an election year. Practical takeaways and strategy: investors should shift focus towards sectors resilient to rate volatility, such as utilities, healthcare, and financials. Bond investors may prefer short-duration securities as long-term rates remain unstable. Business leaders and CFOs should reassess debt exposure and fixed capital plans. High borrowing costs are likely to persist at least through Q3 2025. Budget conservatively. Workers and consumers should monitor inflation trends and employment figures. Avoid high-interest debt and secure fixed-rate loans if borrowing is necessary. Policy watchers should remain alert to tensions between central bank independence and political messaging. Calls for Powell's removal, though unlikely to succeed, could affect markets if not addressed decisively. What lies ahead? August inflation readings and September's job numbers will be pivotal. Any material shift in these figures could force the Fed's hand. The Federal Reserve's next meeting on September 16th to 17th is expected to be one of the most closely watched in recent years. Markets will be laser-focused on Powell's language in that meeting's statement and press conference. Looking for any signal of a policy turn, Powell's firm "too soon to say" on rate cuts reminds us that monetary policy is not just data-driven, it's also perception-sensitive. The Fed must weigh inflation realities, economic headwinds, internal dissent, and external political firestorms. This complexity is exactly why the Fed remains on pause, with everything riding on the next few economic reports. For now, businesses, investors, and consumers should stay vigilant, stay diversified, and prepare for a potentially bumpy second half of 2025. The Fed's next move is not guaranteed, but its consequences will be felt across every corner of the economy.